Hello and welcome to our Convergent Q1 2021 quarterly investment themes. This is the first time that we're doing this more deeper dive into what we're seeing at Convergent Wealth Partners in terms of what we saw in the previous quarter or year, and then what we're seeing coming up here in the near future. So excited to bring this newer, deeper dive into our investment process to you, as well as just looking forward into 2021. We're going to be bringing a lot more from a video standpoint to you, bringing in different experts from the industry on topics we think you might have some interest in, as well as even more members of our current Convergent team adding their insights into topics that they really have a deep level of knowledge around. And so excited to bring more of that to you here throughout 2021. So I'm going to start off and I'm going to be sharing our quarterly themes deck with you. And I hope you guys enjoy this as we dive a bit deeper into what we see coming up. So, just looking back first into 2020, you don't need me to tell you that 2020 was a challenging year in many ways, and that, to be honest, 2021 hasn't started off significantly better. But as a company, I really think we learned a lot in 2020. We recognized where we needed to add to our process. And I really look forward to sharing with you some of those insights through the video today. So as I mentioned, we're going to be doing this deep dive each quarter going forward, kind of looking back the previous few months as well as looking forward. We don't have a crystal ball though, so we're just going to be doing our best to give you the research that we've seen and that we're looking at to give you some insights, at least from a predictive standpoint, on where we see things going and what that will mean for your investment portfolios and how we're going to be managing our models. So, over the course of the video, here's the three main things that we're going to be covering today. First is we're going to be doing a bit of a deep dive on what happened in 2020 and kind of how that impacts what we see going forward. We're going to then deep dive into what we see coming in the next few months and talking more about some of our new research partners, as well as introducing you to what we're calling the quads. And then finally, we're going to talk a lot at the end of the presentation around the death of the 60/40 portfolio and what that might mean for how we should be thinking about investments beyond just the next few months, but really potentially for the next decade. But before we jump into the 2020 review, I just want to go over our investment philosophy here at Convergent Wealth Partners. It's really all about helping you and your investment portfolio live in alignment with your goals. We believe first, it's just as important to find out the why you investing your money, not just the how that you want your funds invested. And then we really focus on creating a personalized strategy based on that assessment of your willingness to take risk within your portfolio. And that really helps us answer three main questions. Do you have enough? Is it in the right places? And which assets do we need to tap first if and when you decide you need to begin taking income? Once we know all those answers, that's when we can really identify the optimal investment strategies and allocations to meet your goals. So it's not just looking at your individual stocks and bonds and net worth. It's really a deeper process that involves really attaching that to your most important goals and values. So let's jump into looking into what happened in 2020. As we mentioned, quite a crazy year. And really, if most people don't really remember this, but if we just look at the first really 6-7 weeks of the year, the market kind of got off to a roaring start and was, really hit all-time highs about mid-February, even as we were beginning to get some of the news out of China that the virus was starting to pick up speed there. So it was, mid-February that we were hitting all-time highs still. However, once the news got out that this virus wasn't going to stay within the borders of China, that's where we saw this massive market sell-off, one of the fastest, if not the fastest in market history, dropping 36% in just 23 trading days. And then thankfully, between the Federal Reserve and the government, they responded in an unprecedented way, providing emergency lending facilities, dropping interest rates, and a large amount of stimulus into the economy through the CARES Act. So between all of the different policy measures that they took, it provided a significant amount of cash flow that really supported the stock market, probably in a much bigger way than I could have anticipated. However, in spite of some of those measures coming in, we still saw a massive spike in unemployment that really, again, the fastest rise in unemployment in history, and also the sharpest drop in GDP in history. And with our models, which are economic and volatility based, early in March, really the first couple of days of March, we had shifted to a pretty conservative position because of the amount of negative economic data that was out there and the volatility. And really because that data persisted, we really stayed in that more cautious position for much of the next couple of quarters. And really, one of the main reasons we were looking at that is that we expected a second wave of COVID and potential uncertainty in the election coming in November. And in reality, we saw all of that come to light in September and October, as we saw pretty large drawdowns of 8% and 6% in the S&P 500 in those months. But as we got to the election and that it came and went, it really appeared that there was more of a relief that it was over. and less of a concern that we actually got the contested and uncertain election that we expected, with President Trump threatening lawsuits all through December and really even into the beginning of January. However, we also received really good news on the vaccine front shortly after the elections, and the market headed to all-time highs again, even as we saw additional lockdowns due to rising COVID cases and even higher levels of unemployment. So really 2020 to me was a year of learning for myself and our firm. And really the age that we're in, clearly information is moving faster than ever has before. And our models really were based on taking in existing data that came in and adjusted it, looking at that. And this methodology has worked over the years, but we realized we needed additional research that was not only kind of taking that information, looking at it the current state, but taking that information and looking forward and bringing in some predictive data to determine, again, not with certainty, we don't have a crystal ball, but at least from a probabilistic standpoint, how might this data be impacting things going forward, and what might that mean for the decisions we're making around your investment portfolios? So that leads us into, what we see coming in the coming months and quarters. So our process, for model management has now expanded, and we've added a new research partner called Hedgeye Risk Management. And, in addition to some insights on how we kind of measure and map economic and market changes, most importantly, they've brought us this whole concept of what we're calling the quads. And they're all about mapping the economic environment that we're currently in, as well as using predictive data to identify mostly probable outcome for economic growth, inflation, and government policy in the next upcoming quarter. So the way it breaks down is quad one is an economy where we've got economic growth accelerating, but inflation slowing. Quad two is economic growth accelerating, but also with inflation accelerating. Quad three is economic growth slowing, but inflation still accelerating. And quad four is economic growth slowing and inflation slowing. So kind of quad four is kind of the worst case scenario that we saw in the first quarter, in second quarter of 2020. So what does that mean for our belief about where things are headed in Q1 2021? So despite all the fears of continuing COVID challenges, political and socioeconomic unrest, and a market that's still at or really near all-time highs, Q1 really is appearing to shape up into quad two in the US and really much of the rest of the world. And really the drivers behind this are, the first and foremost, is GDP growth expectations. So if we look back at 2020, we saw the sharpest drop in GDP in Q1 and Q2 in the history of the measurement of GDP. And while we're not going to be back to pre-COVID levels on the economy by the end of this coming quarter, in terms of comparative numbers, it's going to look much better. So in terms of year over year growth, we're going to be in the green there. And also if we look at inflation, which is one of the other big measurements of our quads and our vision looking forward, is inflation forecasts and expectations continue to rise. And right now we have Bloomberg consensus around an expectation of 2.61 by the end of Q1, and Hedgeye, one of our research partners, expecting actually to be at 3% by Q1 or Q2. And so both of those metrics, if we look back at at the quads, that's what leads us to a quad two expectation for this coming quarter. On top of that, between the Fed continuing asset purchase programs and some of the recently announced stimulus programs from the Biden administration, we should really continue to see the support of asset prices that we saw in the second half of 2020. And then finally, one additional component to all of that is the corporate profit cycle. So not only did the economy have a sharp drop off, so did corporate profits. And similarly to really better comparative numbers for GDP in Q1 and Q2, we expect to see much better numbers from a corporate profit cycle in Q1 and Q2 as well. So in spite of all that, though, we have this optimism and we are going to see some relative strength in the GDP and inflation and the overall economic growth in Q1 and Q2, which should lead to supportive asset prices. There are still reasons for concerns. First and foremost is this whole concept we've spoke about a number of times on these videos, is this K-shaped recovery. So while asset prices have done well and certain sectors of the economy have done really well, there's really other areas of the economy that have struggled severely, in particular small businesses that have closed at extremely high rates and are struggling to stay afloat right now. And we expect that continued social unrest and continued challenges in those areas still to come. While we have seen a growth in jobs since the bottom, we're still in a position where we're short a number of jobs that we were at prior to the pandemic beginning. So there's still this large gap in unemployment that's going to be persistent for many months and potentially years to come. And then another big one that has some people concerned is how quickly we are really going to be able to roll out these vaccines, which is then going to lead people to feel comfortable potentially really going out and doing the things that they wanted to do before, the travel and really this pent up demand that we've all talked about. And really another one, big one overall, and this one may be more longer term, is this whole idea of the fourth turning that we've talked about a number of times in our videos and blogs. And it's really this concept that we're going through a generational shift. And we've had this long period of time of income gaps widening between the wealthiest and the poorest, which you can see here on this slide, which shows the rise in corporate profits versus individual incomes, US personal incomes over the last number of years. And because of that, it's creating this large amount of socio and economic unrest. And we don't anticipate that being a short-term thing that's just going to end because we've had a change in administration. We see this something that could persist not only short-term, but into the long term. So in summary, for Q1 investment themes, again, we're heading into quad 2, not only in the US, but globally, which means higher growth and higher inflation. And there's certain areas that historically have done relatively well when we're in quad 2. Number one, equities in general perform well when economic growth and inflation is beginning to accelerate. So equities in general, but especially growth. Also, the next two are really typically work in conjunction with each other, which is emerging markets and commodities. So emerging market economies are typically based on natural resources and commodities. And so if we anticipate inflation and we anticipate the price of those commodities rising, it should support the economies of those emerging markets as well. So in our models, those are some of the areas that we've emphasized and focused on in terms of how we've been allocating for Q1 in 2021. So while we believe the next quarter, maybe even the next couple quarters are going to be in quad 2 with solid economic growth and rising inflation, we still have concerns that simply inflating the current stock market bubble to higher and higher levels may not be really the best thing for the long term. And really with our new administration likely focused on shifting support from supporting asset prices for the top 0.1% to more evenly spreading out the support from government and the Fed, we could see wages and prices rise to levels that we've not seen in the recent past. And so there's many unknowns at this point. And so, we can't really predict where things are going, but there is cause to believe that maybe the things that have worked in the past may not work in the future. So the chart that you're looking at here is a chart of history going back many years to show that, we've been in a relatively stable place with inflation for a very long time. But if we go back to the 70s, we've seen levels of inflation that would have dramatic impacts on the ability for people to sustain their current income levels, especially in retirement when they're typically on more of a fixed budget. And so, over the past 40 years, a portfolio, if you just picked a very basic portfolio of 60% equities and 40% bonds, that portfolio has performed extremely well, not only from a pure investment performance, but also risk reward performance, as we've had a situation where the economy has been steadily growing and interest rates have been steadily declining through that time frame. But how we believe we may be headed down a path of a major cyclical change. And so what has worked over the last 40 years, while we've had this steady economic growth, low taxes, low inflation, will not likely work as well in the coming years and maybe even the coming decade. So to help better understand what we may be heading into, I'm going to use a sports analogy, if that's okay. And so many of you will know the name Dennis Rodman, and some may know him for unrelated reasons, particularly trips to North Korea and his kind of flamboyant personality. However, we're going to focus on his basketball career and trying to explain how we believe it relates to the 60-40 portfolio. So, that's a great question. What does Dennis Rodman, one of the most colorful basketball players in NBA history, have to do at all with your investment portfolio? So just some background on Dennis Rodman. He's one of the lowest scoring inductees into the Basketball Hall of Fame. He was never a threat to score when he was on the floor, yet when he was on the floor, the offensive efficiency of the teams he was on went through the roof. And personally, I experienced this firsthand. I'm from the Seattle area, huge Seattle Sonics fan. Still upset that they're no longer here. But I was massively cheering for our Sonics against the Bulls in that 1996 finals run. And without Rodman, even looking back before that, the Bulls had already won 3 titles, really relying on Michael Jordan and Scottie Pippen's unique talents. So, why did the Bulls mess with a good thing? Whether it was, thinking about Jordan and Pippen with the Bulls, or, why would you mess with a good thing that's worked for 40 years with the 60-40 portfolio? Well, we'll touch a bit more on that shortly, but looking back at Rodman and his career with the Bulls, in his best season with the Bulls, he averaged close to 16 rebounds per game. And about 6 of those were offensive rebounds. So throughout the game, he was providing second and even third chances to Jordan and Pippen, which would lead to probably about 6 points extra per game. And that's enough second chances to take a really great team and make them almost unbeatable. with Rodman, they arguably became the best team of all time. So in isolation, it's hard to consider Rodman one of the best players in NBA history. In reality, a team of Rodmans, really wouldn't be very good at all. But paired with the right teammates, he became almost unstoppable. So again, what does that have to do with your investment portfolio? So just like adding Rodman to an already successful basketball duo, we believe that you should consider adding supporting asset classes to the traditional stock and bond portfolios to deal with the potential cyclical changes that we see coming. And there are asset classes out there that tend to be anti-correlated with the market and tend to do best when there's this lack of liquidity, when stocks are crashing, when bonds are malfunctioning, when there are terrible credit drawdowns. When the rest of the world is drawing liquidity out of the system, these asset classes bring liquidity back into the system. And those asset classes that kind of replicate Dennis Rodman in your portfolio are things called long volatility, commodity trend following, and precious metals. And so we're going to be covering this in a lot more detail. I'm going to be doing a video and a blog series focused specifically on this and bringing in some outside industry experts with a lot of knowledge in these areas in the very near future. But what I'm going to leave you with is this today, in that a portfolio with these asset classes added in, combined with a diversified stock and bond portfolio over a long period of time, have outperformed the 60-40 portfolio. And most advisors and even investors out there right now, it's hard to remember what things were like before 1980, when things weren't so smooth with the stock and bond market. And so I think it's going to be important to really look at, what did things look like much prior to that? And again, these asset classes that you should have in your portfolio in order to help you through those periods of time. So again, we're going to be doing a number of videos and blog posts specific to that in the very near future. So keep an eye on that soon. So in summary, we expect the U.S. and much of the globe to be in Quad 2 in Q1 2021 with rising GDP and inflation. However, there's a number of reasons to be cautious, as many parts of the economy are still struggling to recover and risks of the vaccine rollout being slower than expected, as well as continued socioeconomic tensions are out there. And finally, longer term, we see a larger cyclical shift coming that will require the consideration of additional asset classes beyond the traditional stock and bond portfolio that we'll be discussing with you in our upcoming meetings, as well as future blog posts and videos. So yeah, keep an eye out for all of that to come. So with that, we hope you have enjoyed getting a deeper look into our investment research and what we saw happen in 2020, what we see coming in the next quarter. And we really are excited to bring more of this to you each quarter coming forward and giving you more deeper insights into what we're seeing and what we're thinking. So with that, thank you from the entire Konvergent Wealth Partners team. We hope you have a great day, and we look forward to talking to you soon.